Gold has been used as money for over 5,000 years. In all that time, through the fall of Rome, through world wars, through every financial crisis in human history, it has never done what it just did in the last 90 days. What I'm about to show you isn't just about gold. It's about a fundamental crack forming in the global financial system. And if you understand what's really happening, you'll understand why the next 2 years could be the most important of your financial life. Stay with me. Let me hit you with a number. In the last 12 months, gold has risen by over 40%. 40%. For context, gold's average annual return over the last 50 years has been about 7 to 8%. That means gold moved in 1 year what it normally takes 5 years to do. But here's the part that should really make you stop and think. Gold didn't do this because of a war. It didn't do this because of a pandemic. It didn't do this because of hyperinflation in America. On paper, on the surface, everything looks fine. GDP is growing, unemployment is low, the stock market is near all-time highs. So why is the oldest, most boring, most, quote, safe asset on Earth behaving like a penny stock on steroids? The answer is terrifying, and it starts with a number: 35 trillion. The United States of America, the most powerful economy in human history, currently owes $35.5 trillion. I want you to try to visualize that number, because your brain literally cannot process it. If you stacked 35 trillion $1 bills on top of each other, the stack would reach the moon and back 4 times. If you spent $1 every single second, non-stop, 24/7, it would take you over 1.1 million years to spend $35 trillion. The dinosaurs went extinct 65 million years ago. You wouldn't even be a fraction of the way through. But here's what matters for your money. It's not the size of the debt. Countries have had large debts before. It's the speed. The US added the last $1 trillion of debt in just 100 days. Let me say that again. 100 days. $1 trillion. That's $10 billion of new debt every single day. $415 million every single hour. $7 million every single minute. In the time it's taken you to watch this video so far, roughly 2 minutes, the United States has added $14 million to its national debt, and it's accelerating. Now, this is why gold is going parabolic. Not because of inflation headlines, not because of geopolitics, because the smartest money on Earth, central banks, sovereign wealth funds, multi-generational family offices, they're all doing the same math. And the math says this is unsustainable. So let's connect the dots. Dot number 1. Central banks are hoarding gold at a pace never seen before. In 2022, central banks bought 1,082 tons of gold. That broke the record. In 2023, they bought 1,037 tons. That was the second highest ever. In 2024, they did it again, over 1,000 tons. 3 consecutive years of record or near record buying. But pay attention to WHO is buying. China's central bank has officially added over 300 tons in the last 2 years. Officially. Analysts at Goldman Sachs and JP Morgan estimate the real number could be 2 to 3 times higher because China routes purchases through undisclosed accounts. Poland, a NATO country, doubled its gold reserves. India is buying every single month. Turkey, Singapore, Czech Republic, all buying aggressive. Ask yourself a simple question. What do all these countries know that you don't? Why are they converting dollars into gold at the fastest rate in history? Because they can read a balance sheet, and America's balance sheet doesn't balance. Okay, pause for a second. We're about to get into the most important part of this video, the connection between gold, Bitcoin, and what it actually means for your portfolio. If you're still here, you're already ahead of 90% of investors. But I need you to do something real quick. Drop a comment below with the word gold if this is making sense so far. I read every single comment, and it helps me know what topics to cover next. All right, let's get into the Bitcoin connection, because this is where minds get blown. Here's what almost nobody in traditional finance wants to admit. Gold and Bitcoin are telling the exact same story. They're just speaking different languages. Gold is the language of institutions, central banks, and old money. Bitcoin is the language of technology, new money, and the next generation. But both are saying the same thing. We don't trust the system anymore. Look at this chart. This is global M2 money supply. Basically, the total amount of money that exists in the world. In the year 2000, global M2 was about $25 trillion. Today, it's over $105 trillion. The amount of money in existence has quadrupled in 24 years. Now overlay gold's price. It has almost perfectly tracked M2 expansion. Why? Because gold's supply can't be printed. There's only so much gold on Earth. So when more dollars are created, each dollar buys less gold. Gold goes up, but really, the dollar is going down. Bitcoin does the exact same thing, but on hyperdrive. There will only ever be 21 million Bitcoin, ever. That supply is mathematically guaranteed. No government, no central bank, no one can change it. So when M2 expands, Bitcoin responds even more aggressively than gold. Here's the correlation that will blow your mind. Since 2020, Bitcoin's price has had a 0.89 correlation with global M2 money supply on a 10-week lag. For non-math people, that's an almost perfect correlation. When money supply goes up, Bitcoin follows about 10 weeks later. And guess what's happening right now? Global M2 is expanding again. China is injecting liquidity. Europe is easing. Even the Fed, despite what they say publicly, is quietly providing liquidity through the back door via the Bank Term Funding Program and Treasury buybacks. The liquidity wave is coming, and both gold and Bitcoin are front-running it. All right, so what do you actually do with this information? I'm not a financial advisor, and this isn't financial advice. But I can tell you what the data suggests and what the smart money is actually doing. And I think it comes down to 3 principles. Principle 1, understand the barbell strategy. The biggest funds in the world right now are running what's called a barbell portfolio. On one end, you have ultra-safe assets, gold, short-term treasuries, cash. On the other end, you have high asymmetry bets, Bitcoin, AI infrastructure plays, select emerging market positions. And in the middle, almost nothing. They're avoiding the middle. Generic index funds, the 60-40 portfolio, the set it and forget it approach. Why? Because the middle gets crushed during regime changes, and we are in a regime change. Principle 2, think in cycles, not days. Everything I've shown you today operates on 12 to 24-month cycles. Gold doesn't go up in a straight line. Bitcoin definitely doesn't. If you're checking prices every hour, you will get shaken out. The institutions buying right now aren't looking at daily candles. They're looking at decade-long structural trends. You need to think like them. Principle 3, follow the plumbing. Forget what CNBC says. Forget what Twitter influencers say. Watch the plumbing, the M2 data, the Fed's balance sheet, the 13F filings, the central bank reserve reports. The plumbing tells you where money is actually going, not where people say it's going. I'll put links to all the data sources I used in this video in the description below. So where does this all end up? Let me give you 3 scenarios based on the data. Scenario 1, the base case. The US manages its debt through moderate inflation and financial repression. Gold reaches 4,000 to 4,500 by end of 2026. Bitcoin reaches somewhere between 150,000 and 200,000 during this cycle. The dollar slowly weakens but doesn't collapse. Life goes on, but your purchasing power quietly erodes at 5 to 7% per year. This is what most analysts expect. Scenario 2, the bull case. A genuine fiscal crisis forces the Fed to monetize debt aggressively. M2 explodes higher. Gold goes to 5,000 plus. Bitcoin enters a supercycle and reaches 300,000 or beyond. Real assets massively outperform. Cash holders get destroyed. This has about a 25 to 30% probability in my estimation. Scenario 3, the black swan. Something breaks. The bond market cracks. A major sovereign debt crisis erupts. Everything sells off initially, including gold and Bitcoin, before the Fed steps in with the biggest money printing operation in history. This would be catastrophic short-term, but incredibly bullish long-term for hard assets. Maybe a 10 to 15% probability, but it's the one you need to be prepared for. In all 3 scenarios, notice what the common theme is: hard assets outperform, cash loses. The only difference is the speed and the severity. I want to end with something personal. 2 years ago, I started researching this topic, the relationship between money supply, gold, Bitcoin, and the dollar. And the more I learned, the more I realized that the financial education most of us receive, save money, put it in a savings account, maybe buy some index funds, that That playbook was designed for a world that no longer exists. We live in a world where governments can create trillions of dollars with a keystroke, where the rules of money are being rewritten in real time, where a savings account earning 4% actually loses you money when real inflation is running at 7 or 8%. The single most important financial skill you can develop right now is not stock picking. It's not technical analysis. It's understanding the system. Because once you understand the system, the trades become obvious. Everything I show on this channel is designed to help you understand the system. Not tips, not signals, understanding. If that resonates with you, subscribe. We're building something here, and I'll see you in the next video. The video on the left breaks down the exact M2 correlation model I mentioned, step by step, with the actual data. The video on the right covers the 3 specific AI infrastructure plays that institutions are buying right now. Click whichever one pulls you. I'll see you there.